Welcome to the Deep Dive. This is where we take source material, sometimes a whole stack of it, but today, just one single, really concentrated source, and we just pull out the core intelligence for you. So today, we're going to do a deep dive into the GDMAS dashboard. That's the Global Digital Market Analysis System. And this specific snapshot, it's from the early morning, Friday, January 16th, 2026. And it's not just numbers on a page, it's a picture of a market that is just undeniably in the middle of a huge rotation. Our mission today is pretty straightforward. Understand what's behind this divergence. I mean, you've got precious metals just soaring, and then you have digital assets in, well, what looks like a total free fall. We want to get into why this is happening.
If we connect this to the bigger picture, what this dashboard really shows us is a market that it's fundamentally changed its mind about risk. And it's done it in a very, very short amount of time.
Changed its mind. I like that.
Yeah, because traditional assets are suddenly getting all the attention while these, novel assets are being sold off aggressively. Yeah. So we have to look at not just what moved, but how much it moved, and critically, what it moved relative to. It's a real moment of truth for what scarcity actually means.
Okay, let's unpack this then, because when you first look at the monthly performance table, the story just kind of writes itself in these huge, extreme contrasts.
It really does.
We have to start at the top and the bottom. They tell two completely different stories about value right now. Let's start with what I'm calling the silver phenomenon. I mean, silver, XAG, it has posted a massive monthly gain. We're talking plus 29.95%.
Almost 30% in 1 month for silver.
Exactly. For an asset that usually moves, much more slowly. And gold, XAU, it's not far behind. It's also incredibly strong, up plus 13.63%. So the metals they're the clear winners here, no question.
And that kind of move in silver it's so important. The fact that it's outperforming gold so much tells you something.
What does it tell you?
It suggests this isn't just a generic safe haven trade. It signals that there's probably some major industrial demand under the surface, mixed with that, classic inflation hedging. Silver has that dual personality, precious metal and industrial commodity. A move this big points to real confidence in tangible things.
The speed is what grabs you, but the real story, the real insight is when you look at what's happening to the assets that were supposed to be the new gold.
Exactly. That's the whole story of this snapshot, the extreme contrast.
And right up against those incredible gains in metals, you have this massive deleveraging in the digital world. You can only call it the crypto collapse. Bitcoin, BTC USD, is down a staggering negative 55.76% for the month.
55%. Gone.
More than half its value wiped out in the same 4 weeks. Silver gained almost 30%. And Ethereum isn't spared either. ETH is down negative 10.55%, and Litecoin LTC is down about negative 5.98%.
A 55% loss in 30 days it's just brutal for anyone holding it. But for us, for the learner, the most important number on this whole dashboard might be the relationship between the two, the old scarcity and the new.
You're talking about the BTC IXAU index.
The Bitcoin to gold ratio, yes. And it shows complete capitulation.
How bad is it?
The BTC IXAU index is down negative 76.79% for the month.
Wow, 76%.
That number right there is the clearest proof you could ask for of a violent capital rotation. It's telling you investors aren't just selling speculative assets. They're actively, explicitly choosing gold over Bitcoin as the better store of value on this date.
A 76% collapse in relative value. It puts a fine point on the difference between digital scarcity, which is perceived, and physical scarcity. The market is making a decision right now, in real time.
Precisely. It's a total rejection of that recent digital speculation and a hard pivot back to assets with, thousands of years of history. And if you look at the weekly graph in the source, the visual is just incredible.
Yeah.
Silver's yellow line is just taking off, separating from everything else, while Bitcoin's purple line is in nosedive. The split is total.
And that volatility, it's not just at the extremes, right? It ripples out. Let's shift over to the currency markets, because that's often where you see the underlying fears about stability. And we're seeing a big divide there, too.
Currencies are absolutely key. They tell you where global capital thinks it's safe to hide. When things get this choppy, capital looks for a safe harbor, and that harbor is, so often, the U.S. dollar.
And the data backs that up completely. You see huge strength in the U.S. dollar, the USD up plus 5.22% for the month.
A big move for a major currency.
A huge move, and that strength is pulling up its partners, too. The New Zealand dollar, NZD, is up plus 3.46%, and the Australian dollar, AUD, is up a little bit, plus 0.34%. The strong dollar block is really holding. But then you look across the oceans, and it's a different story. It's a story of pain. The Japanese yen, JPY, is down negative 3.81%. The euro, the EUR, also down significantly, negative 3.86%.
Even Swiss franc, which is that traditional neutral haven.
Yeah, even the franc is down negative 3.36%.
And the one to really focus on is the Canadian dollar, the CAD. It saw the biggest drop of all the major currencies we're tracking here, down a really sharp negative 4.84% monthly.
Okay, so when you see that pattern, a surging US dollar and at the same time a broad weakening pretty much everywhere else, Europe, Asia, what does that tell you about how the money is actually moving?
It screams deleveraging. A strong dollar like that means global capital is selling other things. They're selling their euro bonds, their Japanese stocks, and they're converting it all back to US dollars for safety.
So it's a repatriation of capital.
Exactly. And that creates this massive demand for dollars, which pushes its value up. And that, in turn, forces the yen and the euro down against it. We can actually see that confirmed in the DXY, the US dollar index.
Right, the basket of currencies.
Yeah. The DXY is showing a plus 0.31% weekly gain in the strength panel. It is just reinforcing that momentum. The market is shouting that when the going gets tough, the dollar is still the undisputed king.
That makes a lot of sense. The same fear pushing Bitcoin down is pushing the dollar up. Now here's where the picture gets, I don't know, a bit more complicated. Let's look at energy and the stock markets to get the full view.
Right. We need to see if that demand for tangible physical assets that drove up silver and gold, is it showing up anywhere else?
And it is. Looking at energy, we see some sustained strength. Brent crude, BRM, that's the international benchmark. It's up a very healthy plus 7.67% monthly.
And WTI.
West Texas Intermediate, the U.S. benchmark, is right there with it, up plus 5.79%. So you're seeing money consistently flow into physical stuff. Precious metals, check. Essential energy, check. The whole trend seems to be about supply fears, maybe some geopolitical stress, or just good old-fashioned inflation that, cash can't protect you from.
That's it. It signals real underlying demand. It's either industrial demand looking ahead, or it's people stockpiling because they're worried.
Yeah.
And it's structurally linked to the metals trade, but it's the absolute opposite of the speculative fire sale we saw in crypto.
Okay, so now we get to the part of the dashboard that, for me, is maybe the most confusing bit, given all this wild volatility, and that's the stock market. If capital is just gushing out of crypto at 55% a month, you'd think equity markets would be in a panic, but they're not.
And this is the nuance, right? This is what separates a targeted deleveraging from just a blind, generalized panic. If we look at that weekly strength and weakness panel, the snapshot is, well, it's mixed, but it's mostly stable.
We see small gains in some of the international indices. The Australian AU200 is up 0.5%. The UK 100 is up plus 0.71%.
But the big U.S. indices, the ones that usually set the tone for global risk, they're basically flat or down just a tiny bit for the week. They are not crashing. The S&P 500 is down a mere 0.15%. The US 30 is flat at plus 0.01%.
Why aren't stocks getting hammered if everyone is supposedly running for the dollar?
I think that's the absolute key question here. It suggests the market is making a distinction between speculative risk and what it sees as fundamental business value. The crypto liquidation is like, it's skimming the froth off the top of the system.
So it's concentrated pain.
Very concentrated. It's targeting those specific highly volatile assets. The fact that the major indices are holding steady suggests that investors might believe that, U.S. corporate earnings, the long-term economic picture, that stuff is still okay, even if the speculative edges are getting torched.
Is there any weakness showing in stocks at all?
There is a little. And it's exactly where you'd expect to see it. The U.S. T-Tech, which tracks the tech and growth stocks, it's the weakest of the U.S. majors. It's down narrow 0.59%.
Okay, so that fits the pattern.
It does. It reinforces the idea that the high growth, high valuation parts of the market are feeling a little bit of the same pain that just destroyed crypto, but the core market structure is, for now, holding firm.
So to synthesize this whole GDMAS picture from January 16, 2026, the market it's heavily favoring physical assets, the old school stuff like precious metals and oil. It's aggressively moving into the US dollar. And at the exact same time, it is punishing digital assets with extreme prejudice. And the stock market is sort of holding its breath.
Okay, so what does this all mean for you? As a learner trying to process this, we need to boil it down to the essential, memorable takeaways that define this market moment.
I think the biggest takeaway has to be that dual shock, that polarization. You have a nearly 30% gain in silver in 1 month.
Which is just incredible. It's incredible. And that's fueled by this deep need for tangible value. And then at the same time, a 55% collapse in Bitcoin, which is a harsh, immediate rejection of digital speculation.
Yeah.
This is more than just a simple risk-off move. It feels like a global re-rating of what wealth preservation actually is.
The whole dashboard just shows this pivot then. A pivot to real assets XAG, XAU, and a pivot to the strong dollar. It's a market that isn't just de-risking, it's despeculating.
And that raises a really important question for anyone trying to build a long-term portfolio. When you see asset classes diverge this violently, I mean, when the ratio of Bitcoin to gold collapses by 76% in 4 weeks, is that just a temporary mood swing that's going to snap back?
Or is it something more permanent?
Or is it a sign of a more fundamental, maybe longer-lasting reevaluation of how we price risk, of how much risk these new technologies actually carry versus the bedrock value of physical assets? The sheer speed of the collapse suggests it might be the latter.
It really is the speed and the scale that make this so important. Given that the BTCI XAU ratio fell off a cliff, down over 76% in a month, how quickly could that even reverse? And more to the point, what kind of global event, what specific catalyst would it take to get that capital to flow back out of physical silver and gold and dive confidently back into the digital world? That's the challenge this data presents, and that is something for you to mull over.